In this video, we're going to discuss what is fraud. The second one is what is actually fraud triangle is all about. And the third one is what are the some red flags in financial reporting, because financial reporting is the input in case of financial analysis. So if financial analyst has to be known, like what are the things that I should be aware of, and what raises the eyebrow, which requires some special attention in your financial statement analysis. Special attention. Now let's look about what do you mean by fraud. What does fraud means? Look, this is a guy. Suppose this is Mr. X. That guy made some mistake. He made some mistake because he's a human being. Like a human being are prone to mistakes. He made a mistake. Now we need to understand whether that mistake is deliberate. If he has made deliberately mistake to conceal something, to sabotage something, some asset, to misappropriate some asset, I would consider them as fraud, because he knowingly did something for his own personal gain and he cheated the world. And second thing, it may be an error because a human being, so I should ignore it, because for me it is very, very important to distinguish between an error and a fraud, because the consequence of fraud is very severe. Because the detection of error is easy, but the detection of fraud is very difficult, and the consequences of fraud is different from error, as we know. So basically what we do is, like, if someone does a mistake, we generally bifurcate into two parts, like whether it's an error and whether it's a fraud. If it is deliberate and it wants to conceal some assets, you want to misappropriate some asset or hide some asset or hide something, or to want to cheat the world, then in such a case it's called fraud. And basically if you want if it is not fraud, then we consider this as an error. Now let's discuss something on fraud triangle. As it's a triangle. I just told fraud triangle. So what do you mean by fraud triangle? The first thing in the fraud triangle is the pressure. I'll write down the names. And the second one is the opportunity. And the third one is a rationalization. Now what do you mean by fraud triangle? So if these conditions exist in an organization, then I will say there are high chances of fraud. Because let's drill down each of the component of the fraud triangle. The first thing is the pressure. Think about a company which is listed, or it has taken debt from some banks. So when people take loan from the bank, they have to maintain some ratios, like the current ratio should be more than 1.5 or 2, or the earnings should be this much, the operating profit should be this much, they should not take debt, or the expectations are high from the management. So it creates pressure for the management to perform in a certain manner to achieve some objective. If they are not able to achieve the objective, then in such a case it would be very difficult for them to justify why they have not achieved their objective. Then they seek for any opportunity that may exist in an organization. Generally they are management, they can find the opportunity. If there exists opportunity for them, because they are already pressurized to achieve some objective, and if they do not achieve the objective, then the consequences might be severe. They seek for the opportunity. They seek for the opportunity in the weaknesses in the internal control. They seek in the weaknesses in the information system, or they may override the controls. After seeking the opportunity, okay, they can commit the fraud. The third filter is rationalizations. I would consider it as an ethical filtering, which means this is the last filtering in the fraud triangle. If the guy who is conducting the fraud is able to justify why he's conducting the fraud, For example, is I already gave the example of a listed company. If they are not complying with the covenants. Okay, any rules and regulations given in the indenture or given in the loan document, we call this as covenant. So if the entity is not able to comply with the covenants, then the debt may become payable on demand, or it may have some other financial consequences, or the entity may not be able to conduct the business properly. The stock prices will fall down. So there are many rationales, many reasons in order to protect the investors. Okay, or else we are doing it for the first time, we won't do it again, or in such a case, or think about another scenario where during the interim period, their previous year the earning was 5%. This year the earning dropped down to -2%, and they communicated in their meetings with the analysts that the earning would be around 7.5%. Look, the deviation is around 9% in the negative directions. So in such a case, the share prices of the company will fall down when this result will come up, which means will automatically leads to some wealth destruction of the shareholders. Then in such a case, what they will do is like, okay, we're gonna conduct this fraud for the first time, and we won't repeat this mechanism again, because the green days are coming, and we will be able to rejoice those green days, and we will be able to recover from the losses. So this may be a part of rationalization. If these things exist in an organization, it's very likely that there will be chances of fraud. So as an auditor, the first thing we do is like to check and understand the most important thing. As an auditor, we check this thing, related party transactions, because most of the fraud are conducted through the help of this, because what I understand from this, because transactions between this party are prone to fraud. These are certain areas, these are certain indicators that the financial analyst should look into in order to identify fraud, like in order to identify as some indicators in relation to fraud. So these are certain things which may give an indication that there's something wrong in the financial statement, or there might be chances that the financial statement might be cooked. So the first thing is the net margin or the net profit and the cash flow from the operations. If the net profit is continuously going up and up and up, and there are negative cash flows, or the cash flows are difference between the profit and the cash flows are significant, then in such a case, like if I'm able to make sales of 100 rupees and the net profit is 10, at least I'll get 8 rupees as my cash. So over the course of action, from my operating income, I'm not able to generate the cash that I sold, then in such a case, there might be chances that I may be booking some fictitious sales. So this may be a reason to believe that there is something wrong in the financial statement. Then we need to look into the variability in various key indicators like your sales, your profit as compared to the prior period. Like what you do, for example, if the net sales in the prior period is -10% and this year is 40%, look, definitely there's a raise of 50% as compared to the prior year in the total sales. Or if, like for example, if the sales are 10% and this year the sales are 30%, well, the industry is not doing good and the total sales of the industry is 15%. So it's like it requires further investigation, further understanding, like what the business what the people has generally actually did, what the business has actually did to beat the industry itself. So this thing we need to understand. The third one is the justification of certain intangible assets. This is intangible assets. Like, one thing I want to say that there are two areas that the financial statement can be cooked. There are three areas. The first one is the debtors. The second one is the inventory, and the third one is the intangibles. So we need to be very, very careful about these three areas: the debtors, inventory, and intangibles, because intangibles are prone to impairment, but also intangibles are prone to fraud. Anything, for example, I came across a company where they are doing some advertisement expenses and they are booking it as a deferred expenses for customer acquisition costs. So this is completely wrong. If you are incurring some kind of an advertisement expenditure, you should book the expenditure in the year in which you have incurred it, rather than deferring it to the next concurrent years. Like in the name of deferred customer acquisition costs. So we need to be well aware about these terminologies and well aware about these techniques. Like unusual ratios as compared to the industry, I've already discussed in point number second. But what we can do further here, we can compare for example, we can take the turnover ratios, or we can take the collection ratios or average payment ratios or the cash conversion ratios, like different day period ratios, the activity ratios, and compare the same with the industry. One of the important ratio I would like to say here is your collection ratios, like how long it takes for the company to collect the cash, or like the data turnover ratio. That would be very important for me to understand. And this is very, very important, the related party transaction, because most of the fraud occurs through the help of this mechanism. They are making transactions through the related party and this consolidation of subsidiary. I came across one case where what happened is, like, they consolidate a subsidiary only when the times are good, which means there are profit with the subsidiary. They will consolidate, and after that, if there are not much good years, or there are not profit in the subsidiary, what they used to do is, like, they sell off some of their holdings and they won't consolidate. So it's very important for me whether there are volatility in your consolidation itself, because in some years you're consolidating, in some years you're not consolidating. It's one of the most important cases that I've found in US and raises the eyebrows. And the other one is a revenue recognition policy. If you are booking revenue aggressively, you need to check, like, what's their revenue recognition policy from footnotes and from the accounting policy section, and compare the same with the industry, compare the same with the peers, and make a brief understanding, like, whether they're booking revenue early or whether they are booking revenue on a later date. Like, we need to understand whether they're fairly fairly booking their revenue or not. So these are certain things that we need to be well aware about.